Is whole life insurance actually a good place to put your money? Specifically focusing on the cash value and death benefit long term, but if you're focused on the cash value, you've considered it before. Does it work? I hear these good things about it. I hear big banks and corporations and the wealthy using it, but then some people just tell me to steer clear of it. And these horror stories where people have just been ripped off, lost their money, makes no sense at all. Wouldn't it be nice if I could actually see a policy that has lived the test of time and I can see actual proof? Well, yeah, that would be nice. Now, the past video, we just looked at a historical example. We're going to look at one in this video as well to have some fun. And if you're subscribed to our membership program or if you're working with us, reach out anytime. We've got historical policies dating back to 1975, specifically focused on the cash value, validating that it does work with the net internal rates of return. Strongest policy we have on record, produced a net IRR north of 7%. But that was issued in 1975 and lived through a very high interest rate period. Realistically, to set expectations properly, if you're starting a new policy today, I'll often state between 3 to 5% net IRR, internal rate of return, net growth rate. Could do better, but setting expectations more conservative is a better route to go in my opinion. Now, in this case study, we've got someone that started a policy. This was a policy I put in force back in 2013. It was technically 2014, but we backdated the policy because they wanted to get money in quicker. So she has a policy date of 2013. She was 67 years old when she started the policy. Standard rating, so not an ultra preferred or even a preferred health rating, well-designed policy with one of the major mutual carriers, beefed up for cash value. However, the death benefit is very important in this case as well. But it's very important long-term from a legacy play standpoint. So really what we're gonna look at in this video is a really interesting case where she's done funding. She's coming up on her policy anniversary date in September. We're shooting this video in September. She's got about 2.5 weeks before she needs to make this decision. She's already made it. Something came up where she might change her mind, but she's right there. But the decision she needs to make is, do I keep making payments or do I stop funding it as I originally planned? And if I stop funding it, how do I still see strong cash value growth and also maintain the death benefit I originally wanted? How do I get the best of all worlds in that respect? So we're going to look at that because she can make a pivot here and you're going to see exactly what she decided to do. It's really interesting. Anyone can do this with a whole life insurance policy, but the important thing is if you're working with someone, they've got to have the insight or knowledge or working with a group that has knowledge on these types of moves to make in order to optimize the value of a policy, which is in your best interest. And I'm talking about the cash value and the death benefit. So, selected one of the major mutual companies. Major mutual companies are who? Mass, Guardian, New York Life, and Northwestern Mutual. Started at age 67. She is 74 now, going on 75, entering policy year 8. Wants to maximize the IRR, cash value, and death benefit. Leaving a legacy is very important to her. And then cash value and death benefit impact with the different options. What's the impact on the different options? We're going to look at no more payments because she wants to stop funding. We looked at options where she kept making payments and she actually said, hey, let me just talk to you. I might throw a little bit more in year 8. We'll see. So if she does, then we'll look at another analysis in the future with that funding going in. But this has been the plan for a while to stop funding. And the options are as follows. Do I maintain the death benefit exactly where it's at? Or do I cut it in order to beef up cash value performance, but then see the death benefit recover quickly over time as well? That's the kind of stuff I want to look at. So here we go. Let's start with the example on the left because this is a lot here. And I'll just break it down one piece at a time. So what do we see here? Payments are what? 0. Annual outlay is 0. What we're doing here is electing a premium offset where the premium still due, but she is not paying it. We have a 1-year term rider attached. That's why we have a level death benefit of $1.2 million. This is a whole life insurance policy. 0 out of pocket. Here's our cash value. Standard non-smoker rating. Annual internal rate of return, so not the average, but what she's earning each year. So she has a dividend rate of 6% this year. That's what this projection is based on, the in-force illustration. We pulled all the values directly from the software like we always do. 6% dividend. Remember that a dividend rate is always a gross rate. After the company's insurance expenses and mortality charges, we come up with our net internal rate of return. This is critical. A lot of real estate investors, engineers, business owners look at this kind of stuff because they're told, hey, you're earning this great dividend. But at the end of the day, they look at the growth, they crunch the numbers with a calculator, and they say, what's going on here? So you got to be transparent with this kind of stuff. So there's the net growth over time. We'll scroll down as well. Maintaining the death benefit at $1.2 million. Now what's also happening here, I should have included this column, there's still a premium due that she's not paying. So what's happening is the interest on this policy, the dividends and the guaranteed rate, are first paying the premium and the cost of the term, which is minimal, and then the rest is going back into cash value, and that's the net IRR. So we've got some drag on this policy because she doesn't want to pay anything into it, and the reason we would carry the drag is if someone said, I don't want to pay into it, and I want to maintain my death benefit where it is right now, or see it continue to go up. I don't want to see any dips. So as we look at this guy, what do we notice? 95, still at 1.2, a little bit higher. But let's take a look at this. Oopsie daisy. There we go. So let's compare and contrast. Same policy on the right. Here's the difference. Well, no difference here. 0 out of pocket. Year 7, cash value, $575. This is an actual policy, by the way. So that original point I mentioned as far as policies actually producing, this is a standard non-smoker rating, older individual. So if you're younger or have a better health rating, you'll see stronger performance. Like we looked at in the last video, 65-year-old male actually, an older individual, but he had a preferred rating. We saw a little bit stronger performance here, though this one's strong too. Nothing in year 8 goes in. What's that IRR look like? 5.21%. What's it over here? 3.65%. Where's the difference? Like the cash value difference, close to $10,000 more in this value. What do you notice with a death benefit? 966, over here it's 1.2. On your far right, DB or death benefit difference, $233,000. So what we did in this example is the technical term or insurance terminology is a reduced paid up option, eliminated the premium, cut the term rider, dropped the death benefit as low as we possibly could. Now, the advantage to that is beginning year 8, her out-of-pocket 0, but there's no premium due. Remember, in this example, we still have a premium due that we're not paying, the policy's paying for itself. In this example, there's no premium, it's gone. We chopped it off. The trade-off for the insurance company is they say, okay, that is going to initially lower your death benefit, so if you die the next year, less money is paid out to your beneficiaries. Remember, leaving a death benefit, that's important for her. However, because we removed the drag, there's no premium due, what happens with the cash value growth? All dividends and interest do not need to pay a premium first. And look at that IRR comparison. That's a difference. Same company, same dividend rate, just we reduced the expenses. That's why you see a greater internal rate of return. Fun stuff, isn't it? How you can boost the performance on these things after it's issued, if it's properly designed. There we go. If we look at 80, where are you at with the death benefit? Let's look at this actually. Cash value difference in purple, death benefit in gold. At age 80, you've got $55,000 more in cash value and about $100,000 less in death benefit. That's a decision she has to make. totally up to her at the end of the day, but still providing the options as she is concerned about the cash value growth. Yes, the death benefit's important, but I don't want to assume that, hey, we're just going to leave it up no matter what. If it was me, I'd want to see this option as well. So compare them side by side. Go through the proper talking points as well. And what do we notice? If we look at 85 to 90, I mean, call it expected mortality, right around that for an insurance company. The one on the right is greater. And what you'll notice is if we kick the dividend rate down, or if we look at the guarantees, the one on the right is amplified. When you look at a reduced paid up option, cutting those insurance expenses and guarantees, that'll look very strong. We've had some videos on that in the past, so you may be familiar with it. But anyway, we see this option long-term does give her a greater overall value. So this is the kind of stuff we like to look at with individuals and everyone we work with, but actual policies and such, to provide full transparency, and then you can really make an informed decision. We went through this stuff. I remember actually, I must have been what, 26 years old at the time? Something like that. I remember meeting with her, going through these options in the beginning, and showed the maximum cash value, maintaining the death benefit. She liked maintaining the death benefit. Things change over time. Now she wants maximum cash value. But again, seeing those up front goes such a long way. So I hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.